Hello, welcome to our lecture 18 for CIMA P3 Performance Strategy. This one was on futures. So futures, what are they? Well, they're a standardized contract, i.e. they're not tailor-made like forward contracts. They are for a fixed amount of money. They're for a limited range of future dates. But how do they actually work? Well, what they do are they're exchange traded, so it's an exchange, it's not an actual amount of money, it's a buying and selling of a price, so it's not part of your transaction. It's a bet in the opposite direction. So the risk, if you have a currency transaction, say you're receiving $10 million, the risk that you have is that that $10 million is worth a lot less by the time that you get it. So on the exchange trade you will bet in the other direction, i.e. bet in the direction of your risk, so that if that risk happens, it will equally and oppositely cancel out the profit or loss that you have on your currency transaction. So the currency denominations are usually in dollars because the exchange is in the US, and they're given in dollars per euro or dollars per pound. The size of the contract, standard size is usually 62,500 on the exchanges. So it won't cover your exact exposure. You'll have to buy a certain number of contracts and leave a little bit uncovered. Closing out the trade, well, you'll trade in the opposite direction. So if you buy at 1.650, you will sell at the price that's prevailing at the time, say 1.620, and that is the trade in the opposite direction to close out the transaction. The futures are offered in 3 monthly cycles, so you have to choose which contract you're going to have, and we'll look at that in a second. The margin, what you do is you pay a deposit to the exchange, okay? So you enter into your future and you pay a deposit to the exchange, say 10% of the value of the contract. The profit or loss on that is topped up daily, i.e. if your contract is worth more or less, you pay that amount to the exchange or they pay it back to you on a daily basis. So the concept really is that you have a foreign exchange exposure through your business, and the future is a bet, not a transaction. It's a bet in the opposite direction that should exactly, equally and oppositely cancel out our exposure to foreign exchange. Calculations for a future then. Firstly, you have to ask yourself, should I buy or sell a future? Way to do that, look at your contract size currency or your base currency. Ask, will you buy or sell that to undertake the transaction that you're trying to hedge? And do the same to your future. The next question was to choose your expiry date. How do you do that? Well, you choose the first one after your transaction date. So after you're due to receive your $10 million, choose the first date after that transaction date. How many contracts do you want? Well, convert your amount you're receiving or paying at the current future rate. So you've selected your future, convert the amount that you want to change at that current future rate, divide that by the contract size, and that will get you the number of contracts you need. So once you've done your future, you need to calculate your profit and loss. So you do that using your tick size. Your tick size is your contract size times 0.0001, because the smallest movement on the exchange will be 0.1%. So to get 0.1%, we multiply by 0.0001. The movement then will be worked to 4 decimal places. So you work to 4 decimal places and see what the movement has been, and multiply your movement by your tick size, and multiply that by the number of contracts, because the profit and loss will be on your contract if you do your movement times your tick size, and you times that by your number of contracts. Then you undertake your transaction and calculate your total profit or loss. So, the pros and cons of futures. The advantages are that it is an effective hedge. There are no transaction costs for futures, so that's a big benefit to it as well. Also, it's tradable, so you can trade out at any time. It's not like a forward where you have a contract and you have to do it no matter what happens. The disadvantages, however, well, there's no market in the UK. You have to use foreign markets, i.e. the US. You need that upfront margin, so if your cash flow's tight, you might struggle with it. and they're not tailored. You have to work out those contract sizes. Okay, so those are the disadvantages of futures. So that was our lecture on futures. Really the only way to do futures and to understand them is to do lots and lots of examples following the steps that I have set out there.